Daniel.
And I'm Mira.
So right now there is a massive $700 billion tug of war happening in the global markets. And honestly, whether you realize it or not, your portfolio is caught right in the middle of it.
Yeah, that $700 billion figure, It is definitely not an exaggeration. It's, the big tech AI infrastructure boom colliding head on with two other massive macro forces.
Right, which we're seeing everywhere. We are recording this on Sunday evening, June 28th, 2026, by the way. And if you're staring down the barrel of the upcoming trading week, consider this conversation your shortcut to getting well-informed before the opening bell.
Exactly. And just to frame that macro tension, we've got incredibly sticky inflation paired with a newly hawkish Fed under Chair Kevin Warsh, plus severely elevated Middle East oil supply risks. It's a brutal three-way tension dominating the tape right now.
It really is. So our mission for this deep dive is to give you a comprehensive market news recap tailored for the broad investor. We want to establish that baseline macro context.
Right, without necessarily endorsing any specific market view.
Exactly. And before we get going, we do need to explicitly state that this deep dive is for market context and discussion only. It should absolutely not be taken as personal investment advice or, a recommendation.
For sure. All right, let's just get straight into it.
Let's do it. So moving into our first segment, what were the key market movements of the past week?
Well, looking at the big picture from Monday, June 22nd through Friday the 26th, the really dominant theme was this massive risk-off rotation.
Yeah, and it was heavily dictated by the U.S. dollar index.
Right.
Just relentless strength there.
Oh, absolutely. The dollar rallied to a Wednesday close of 101.61 before eventually settling at 101.39. And when the dollar flexes like that, it puts massive pressure on the commodities complex.
Which makes sense. But here's where I actually want to push back a little on the mainstream narrative. You turn on the news, and it sounds like a total market meltdown. But the pressure was highly concentrated.
Yeah, it definitely wasn't a broad panic.
Right. The Nasdaq Composite took a severe 4.6% hit, closing at 25,297.62. And the S&P 500 fell about 2% to 7,354.02.
But then you look at the Dow.
Exactly. The Dow actually gained 0.6%, and the Russell 2000 rose 1%.
Which tells you investors were rotating, not just fleeing.
Yeah, and if you look under the hood at the credit markets, the panic just isn't there. High-yield credit spreads, like the HYG, basically flatlined near 79.83.
And investment-grade corporates, the LQD, actually caught a bid.
Right. So this isn't a systemic credit freeze. It's a classic duration risk repricing as a slow market bleed. It's heavily penalizing those long-duration tech multiples, but leaving the broader credit foundation totally intact.
That's a great way to put it. And meanwhile, over in commodities, we had a wild ride in crude oil. West Texas Intermediate dropped to an intraday low of $68.56 before recovering to $70.28.
Quite the swing.
Yeah.
And yields.
The 10-year Treasury yield drifted down slightly to 4.37%, and the VIX closed at 18.41 after peaking near 20.72 early on.
Okay, so to wrap up session one, the week was basically defined by a targeted tech sell-off and absolute dollar dominance. We're going to take a quick break, but stick around because we've got the weekend news breakdown coming up next.
Yeah, you won't want to miss the geopolitical updates.
And we're back. Let's dive straight into session two. What were the key news events over the weekend and their market implications framed under the contemporary macro context?
So before we get to the weekend chaos, let's look at the immediate radar for Monday, June 29th. We've got a speech by the Fed's Barkin late Sunday night at 11:50 p.m. Eastern Time.
Late one for the analysts.
Seriously. Then a Bank of England pill speech at 5 a.m. Eastern Time, Spain's preliminary June inflation print at 7 a.m., the Euro area sentiment bundle at 9 a.m., and then the Dallas Fed Manufacturing Index, along with some Treasury bill auctions, around 2:30 p.m. Eastern Time.
Okay, so that's the data schedule, but let's talk about the actual weekend geopolitics because, wow, huge escalation in the Middle East.
Massive. On Friday, around 4:11 p.m. Eastern Time, the U.S. launched direct strikes on Iranian metal and drone sites near Sirik and Keshem Island.
But this was a direct response to the shipping attacks, right?
Exactly. But Iran immediately retaliated with drone and missile strikes on Bahrain and Kuwait.
Which is terrifying for the energy markets. I know they agreed to a pause in strikes late Sunday, but Iran is still insisting it will oversee the Strait of Hormuz.
Yeah, that friction isn't gone. And to add to that, the fragile Israel-Lebanon ceasefire framework basically collapsed.
Right, Hezbollah declared the deal totally void after those Israeli strikes in Mabatya.
And if we look at Russia and Ukraine, Ukraine hit Russian energy sites this weekend. Now President Putin is explicitly considering a ban on diesel exports to protect their domestic supplies.
Okay, I have to jump in here because the media reflex is to treat these geopolitical shocks like they're just unpredictable natural disasters, like a hurricane hitting the market.
Yeah, just random chaos.
But if we apply a game theoretic lens here, this isn't random. Both the U.S.-Iran strikes and Putin's diesel threats are classic examples of geopolitical brinkmanship as bargaining leverage.
Oh, absolutely. They know exactly what they're doing.
Right. They're functioning to remind global markets that energy prices act as a consumer tax. It's a very deliberate squeeze.
It's the inflation threat as leverage, which actually pivots us perfectly to the tech side of things, specifically the regulatory and financing tests hitting that $700 billion AI capex supercycle.
Yeah, this was huge news on Friday.
Right around 4:18 p.m. Eastern Time on Friday, the U.S. government intervened to force OpenAI to delay its GPT 5.6 rollout.
Which immediately raises those regulatory risk premiums.
Exactly. And just before that, we had Minneapolis Fed President Neil Kashkari delivering some incredibly hawkish remarks. He said that AI build-out is directly inflationary and is pushing up market interest rates.
Which makes sense, right? Power access is the physical AI bottleneck. But despite those headwinds, the development pace is just relentless. Sunday morning at 6:51 a.m. Eastern Time, Elon Musk announced that Grok 4.5 is already in private beta at Tesla and SpaceX.
It just reinforces that AI capex is a cycle-agnostic arms race. They are spending the money no matter what the Fed does.
Yeah. Oh, and real quick, we also saw global fragmentation rearing its head.
Yeah.
Apple is reportedly lobbying the Trump administration to buy memory chips from China's CXMT.
And Australia just doubled fines for tech firms to 99 million Australian dollars.
So as a listener, I really want you to consider how this tug of war impacts the tech companies sitting in your own portfolio. You've got massive required capital expenditure on one side against a rising discount rate on the other. It's a brutal environment.
It really is. So, wrapping up the weekend, we have a potent mix of inflation-driving energy shocks colliding with rising tech regulation and financing costs.
A lot to digest. We'll take one more short break and then we'll look at the week ahead.
Sounds good.
All right, welcome back. Let's get into our final regular session. What should we watch in the coming week?
Well, looking strictly at the incoming WatchNext data, Tuesday, June 30th, is a heavy U.S. data cluster. We get Conference Board consumer confidence, JOLTS job openings, S&P Case-Shiller home prices, and the Chicago PMI.
That's a busy Tuesday. What about Wednesday?
Wednesday, July 1st, we've got the ADP National Employment Report, the ISM Manufacturing PMI, and the final S&P Global Manufacturing PMI. But crucially, Fed Chair Kevin Warsh will be speaking at the ECB Symposium in Portugal.
Oh, man. After Kashkari's comments, every word Warsh says is going to be scrutinized.
Exactly. And then Thursday, July 2nd, is the ultimate macro test of the week. We get the June U.S. non-farm payrolls and the unemployment rate release alongside weekly jobless claims and May factory orders.
Right. And if those payrolls are resilient, it completely cements the Fed's higher-for-longer regime.
Yep. And finally, Friday, July 3rd, U.S. markets are closed in observance of Independence Day.
Honestly, we're all going to need that long weekend. I mean, as you finish your Sunday meal prep tonight and just stare into the abyss of your brokerage app, you can at least take comfort in knowing your weekend mistakes didn't cost $700 billion in AI capital expenditures.
That is a very solid silver lining.
Right. I mean, between the U.S. and Iran trading strikes, the Fed projecting zero rate cuts, and Putin's diesel export bans, the macro bingo card is completely full. So pour yourself a stiff drink, assuming shipping costs haven't inflated it yet, and get ready for Wall Street's favorite Monday game. Is this a dip to buy or just the beginning of the pain?
I guess we'll find out tomorrow.